There's a lot going on right now in the markets and in the economy. So, is it time to rethink your investment strategy? You bet it is. Hi, and welcome back to Stop Being Sold. My name's Michelle, and I'm here with Brian. And in this video, we're discussing why it's time to rethink your investment strategy, especially if you have a set it and forget it approach to investing. As key economic and political factors change, so must we if we want to stay on the right side of these changes.
Absolutely. This is really important topic, especially with what's going on in the economy, the markets, the Fed rate hikes, the banking
Bank crisis.
crisis, and everything going on overseas too. So we're getting lots of phone calls right now from nervous clients wondering where they should put their money at right now. And note here, well, I'm not covering investment specifics because we cannot, and I will not give specific investment advice. I do have some critical high-level factors I'm going to share with you guys today, things that you need to keep in mind as you navigate these rough waters. If you're watching this and you have a set it and forget it investment strategy, know that it may not be in your best interest today. And if you aren't paying attention and you aren't willing to rethink your strategy and make moves accordingly, you may lose your shorts.
Yes, you may. All right, Brian, let's get to it. A major reason to rethink our investment strategy right now is because of market volatility. So let's start there.
Yeah, market volatility can have both positive and negative effects on a set it and forget it investment strategy, which is typically a long-term buy and hold approach, right? On the positive side, market volatility can present opportunities to buy stocks at a lower price, allowing investors to potentially generate higher returns over the long-term period. In other words, market downturns can be viewed as a buying opportunity for investors with a long-term investment horizon. But on the negative side, market volatility can lead to short-term losses and fluctuations in the value of a portfolio, which may cause anxiety or panic for some investors out there. This may cause some investors to make impulsive decisions and sell their investments prematurely, leading to lower returns over the long term.
Yep. And that's never a place you want to be, is making those emotional decisions based off of headlines.
So true.
Yep. All right. So, question for you. With everything just chaotic right now, should people be buying opportunities, keeping cash on the sidelines for future opportunities, or investing in solid assets to protect their money?
The answer here is to go back to your goals, your time horizon, and your risk tolerance. Find what makes sense. And if it meets your expectations, then add that to your portfolio.
You are not going to give investment advice. I just
You tried.
All right. So let's move on to the second reason.
One thing's been very apparent in the last few weeks, and that's the Federal Reserve is behind the curve. Okay.
Yes.
If the Federal Reserve is perceived as being behind the curve in raising interest rates, it can have significant implications on a set it and forget it investment strategy, particularly for fixed income investments like Treasury bonds, Treasury bills, municipal bonds, corporate bonds, and even certificates of deposits.
So why is that?
Well, when investment rates are low, investors take on more risk in search of higher returns. You know, it's one of the big topics I see searched for on Google all the time, higher yields. Where can I get higher yields at today? That's what we're talking about. When people start searching for that, and this happens, it can lead to asset bubbles and overvalued investments, which can create problems if interest rates rise rapidly and investors start to pull out of these assets. Sound familiar? Haven't we heard that in the media the last 2 weeks?
Silicon Valley Bank.
Silicon Valley Bank. In this situation, a set it and forget it investment strategy may be particularly vulnerable to losses, as investors may be holding on to overvalued assets that are no longer to deliver the same returns.
Yeah.
You may want to consider diversifying that portfolio across a range of different asset classes and investment styles, which can help to spread the risk and reduce the impact of any one asset class experiencing a sudden downturn. Think of all the people that held bank stocks as a major part of their portfolio. Yeah. What has happened in the last 3 weeks?
Right.
Massive downturn. You may also want to consider investing in assets that are less sensitive to interest rate movements, such as dividend-paying stocks, real estate investment trusts. You know, they're less sensitive to changes in interest rates than traditional fixed income assets. So,
okay. So let's talk about inflation, and how that factors into rethinking our investment strategy, especially for those with the set it, forget it strategy. Because it seems like no matter what the Fed does, it doesn't seem like it. Let me restate that. No matter what the Fed does in terms of raising rates, inflation is still here.
Yes, it is. Have you seen the price of eggs lately?
Yeah.
Uh, yeah, they're still up there. They've come down a little bit though. But think about this. If you're an investor with a set it and forget it investment strategy, you should be aware of the impact of inflation on your portfolio and consider adding inflation protected investments into your portfolio to help offset the effects of inflation over the long term. Inflation erodes purchasing power of money over time. We've talked about this so many times, and that can lead to a decrease in the real value of an investment like bonds and stocks.
Okay, so two quick questions for you. Number one,
Mhm.
can you give us an example of an inflation protected investment? And number two, can you give us an example of how this might play out?
Let's go over the inflation protected securities first. Okay,
Okay.
let's use that as an example. One big one that everyone ran to when interest rates started going up from the Fed was TIPS, which are Treasury inflation protected securities, TIPS, and also dividend paying stocks, commodities, energy stocks, healthcare stocks. That's normal investing during an inflation environment.
Okay.
So them are just some examples, but let's go over an example how this may play out for an investor. Let's say you're an investor who holds a bond that pays a fixed interest rate of 2% a year, but inflation's rising at 4% a year. You're still actually losing 2% a year, even though your bond is receiving interest payments. That is called the loss of purchasing power over time. And that's inflation. Inflation can have an impact on stocks, particularly if companies are not able to pass on higher costs to customers. If a company's costs rise due to inflation, but they cannot raise their own prices, their profit margins will be squeezed. And then that leads to a decrease in the stock value.
Okay. Got it. Okay. Wow, that's a lot. All right. Thank you for explaining that. Appreciate it.
No problem.
All right. So while we're on the topic of rethinking investment strategies, if you've been wondering if you should continue to fund your retirement savings right now, we're going to put a link below, pinned comment and in the description, to a video that we did answering that question, which is literally, should I keep funding my retirement right now? Go check that out if that's been on your mind. And while you're at it, don't forget to hit that like button, show us some love, and also subscribe. So Brian, as we wrap this up, I'm just going to recap it. So specifically for people with the set it and forget it, doing that now, you may be carrying dead weight, and it is not in your best interest just to keep holding what you've been holding. You at least need to look at it. On the flip side, you don't want to be making emotional decisions and responding to headlines every 3 to 5 seconds, or seconds, days. You and I've talked about this before.
Right.
You have talking heads on the financial channels that are changing their mind like weekly, sometimes daily. And there's nothing wrong with that, because things are changing, but
They're changing
making
that fast.
decisions based on that is dangerous.
Yeah, don't make decisions based on anything you hear out there, even on this channel. Don't make decisions on that. Go back to your goals, your time horizon, and the way you view your assets moving forward, because they're not going to be there when you're ready to start using your retirement. I
Right.
guess I want to say.
Well, and also you mentioned,
It's about
goals,
you.
risk tolerance too. This is
Right.
huge. How much risk can
Everyone's
you
got a
take?
different one. Michelle, you and I have different risk tolerance.
100%. Yeah.
You're much more aggressive than me.
Yeah, I am. This is true. In a lot of areas, yes, I am.
It's all right. You're good. You're
But,
good. But
but
no,
also I have a longer,
that shows the difference right there.
for
Even
sure.
between you and me, we have a different philosophy on investing.
Yeah.
So
Well, and I also have I have different time horizon. Our lives are very different.
yes,
And, you have family, I have a dog. So there's that to consider too.
I got a dog
And
too.
you do have a dog. Very cute dog. All right. So thank you so much, Brian, for explaining this all. Appreciate it. Anything else you want to add before we wrap it up?
No, remember this, like Michelle and I just said, this is about you. You know, what fits you is where you should be. How's that?
And what are you
This is
comfortable
about
with?
your retirement, not ours. So
For sure. Okay, there you go. Again, hit that like button, help us grow this channel. Don't forget to subscribe. And if you have questions, drop them below. Brian and I are always answering questions in the comment section. All right. Thanks so much, Brian. And thanks to everyone who watched.
thanks, everyone. Have a great day.